The traditional way to think about the stock market and think about future returns is to start with the level of profits in corporate America, which are at all-time high today. But if you're thinking about the market, you want to look at the profits within the companies of the S&P 500. In addition to that, you want to say how fast are those profits growing, what are the growth rate over time, and then you want to think about where's the level of interest rates, and with those pieces of information you could value the market and make an estimation of future return on stocks. Given where we are today, we think stocks are at fair value. The market overall trades at about 17.5 times earnings, which is about a 25-year average, so we're right at fair value. So we think the returns in stocks from here will be fair, which will be earnings growth plus the dividend yield. There's two trends that have been impacting stocks for the last couple of years, but in addition to the traditional way to think about the market. First one is mergers and acquisitions. And this has been a strong trend for the last couple of years and is continuing this year. And there's mergers and acquisitions for both large companies and small companies that is benefiting the market. On the large company side, these are the deals that everyone knows about and reads about in the newspaper. That's when one public company will merge, buy another company in making acquisitions. The part that people don't hear about or investors don't hear about is with smaller companies. And this could be the case where a public company is using their balance sheet and their cash flow to consolidate the industry that they're in by buying smaller privately held companies. And we have a number of top holdings in the value fund that are using this model to grow their sales and earnings. These companies have excellent free cash flow, and they operate in very fragmented industries where we're able to buy small competitors and, in a sense, grow their sales and earnings through acquisitions. The second trend is activist investing. And this is a situation where an investor will buy 1% to 5% of a public company stock, and then they'll engage with the board and the management of that company to affect change. Typical areas where they want to have change are either operationally to improve profits or in capital allocation where they want the company to buy their stock in or to use debt more effectively. These activist investors have raised billions, if not tens of billions, over the last few years, and they are targeting both small and large companies. Last year, in 2014, the activists targeted 200 public companies where they made investments and for focusing on change. We've seen the positive impact of activism in our own portfolio where we had a company that we own, the FAMVX fund, was engaged by activists and had some change and the stock acted positively.